Hello, good evening, everyone.
Evening.
Okay,
Evening.
okay, let's start with our class. So today we are going to change from all other, so we are going to look at group accounts, consolidation. Right, in group accounts, this one is a very interesting topic. In group accounts, we are going to focus much on consolidation, which means we're going to have a company, which is a parent, and this parent is going to have a subsidiary. So if a company has got a subsidiary, it can have one subsidiary or even two subsidiaries. It can have subsidiary 1 and subsidiary 2. So when we talk of consolidation, we are now consolidating the financial statement of the parent and its subsidiary. So in our consolidation, the only thing that we are going to do is to, when it is a statement of financial position, is to combine the assets of the parent and the assets of the subsidiary, the liabilities of the parent and the liabilities of the subsidiary. The same applies to the group profit and loss. We are going to combine the income and expenses, then we have a group profit. So that's, in simple terms, that's group accounts. So we're going to focus much on consolidation. But before we do that consolidation of a parent and its subsidiaries, you will find that there's consolidation rules that have to be followed. You will see as we go, there are consolidation rules like intra-group transactions. You find things like intra-group transactions are going to be eliminated. We have to eliminate intra-group transactions. We have to eliminate common items. So these are the consolidation rules that we have to follow before we combine the assets and the liabilities. So you will see as we go that in intra-group transactions, we can have things like selling between the group. So the profit that was made when we sell between the group, we call it an intra-group profit. So that intra-group profit is going to be eliminated because we're going to say a group cannot make profit or to itself. So anything, inventory whatsoever, which was sold between the group, as long as it is still in one of the group member, we are going to eliminate that profit when we do our consolidation. The same applies if if A took a loan from B, who is a member of the group, then that loan will fall under common items. Then those are the things that we have to eliminate before we do the consolidation. So when you are doing your group accounts, what you look at is the first thing that you have to do is to eliminate common items and to eliminate the intra-group transactions. Then after you are done the elimination, then you can now combine. So in your combine, it's like combining assets for A with assets for B, assets for C, after you have done your year. So the most important thing is for us to understand how do we treat these intra-group transactions, how do we treat these common items so that we can do our consolidation. Right, so that's basically the background of consolidation. Right, so let's look at here. We're going to focus what happens at acquisition date. when we acquire a subsidiary, how do we treat the transactions at acquisition date? So in International Financial Reporting Standard 3, that is business combination, we are going to look at also to look at the accounting treatment and determination of the value attached to the subsidiary at acquisition. So which means here we need to understand what is the value of the subsidiary at acquisition. When you have the value of the subsidiary at acquisition, normally the value of the subsidiary is made up of its share capital, the share capital, the retained earnings, and we can also have other components of equity. Other components of equity. So normally these are this is the value of the subsidiary at acquisition. So if the total value of this subsidiary at acquisition is, let's say you add up all this and you get 100,000. So this is the value of the subsidiary. But you will see that the parent may not acquire 100% of the subsidiary. So in here, if it acquires 80% of this 100,000, then it means the value that it acquired is 80,000. So that is the value acquired by the parent. The difference is now what we call non-controlling interest. So that is going to be the difference. It's going to be the non-controlling interest. Right. I think most of this will meet them as we go. But for now, let's look at the terms that we use in our consolidation. So you will have, as you will see that the parent is going to have control over the subsidiary. So the parent is the investor because it's the one who purchases shares in the investee, who is the subsidiary. And if you guys can still remember it, 2602, when we were doing our FAC 2602, we were saying they can have control if they have more than 50% interest. But here we are now saying as long as they have powers to control the investee, then they have control, irregardless of the percentage of interest held by that investor. Which means even if they have 40% shares in the subsidiary, they can still have control. But if you remember when we were doing our 2602, one of the major item that makes the investor to have control was a share ownership of more than 50%. Right? But for now, we can only have control if they have power over the investee. They have the rights that give it the current ability to direct. So here we're not talking of there must be rights to direct the activities of the subsidiary, and they are also exposed to returns through its relationship with the investee. So they will have power again there, and they will have power if they can also be able to use their power over the investee to affect the amount of return which is exposed. So these are so if it is a theory question, if they ask you when does the investor have control over the investee, these are the terms that you have to select. You have to select this. Right, then let's look at In consolidation, we have two methods of consolidation. According to International Financial Reporting Standard 10, we're going to use, here we use the acquisition method. Then you'll see in our next topic, we're going to use AIS 28, which is the equity method. So the equity method and the acquisition method are different. So for AI International Financial Reporting Standard 10, we're going to use the acquisition method. So the acquisition method is a situation where we have a parent and a subsidiary. That's the acquisition method. So when we do the equity method, we don't have a subsidiary. We only have a situation where you have significant influence, but we're going to do this as a topic. Let's just leave it now. So let's focus on the acquisition method. But for now, we should know that we're going to deal with two methods of consolidation, which is going to be the acquisition method and the equity method. So the acquisition method is a situation where we have a parent that takes over a subsidiary. You will see when you do your questions. I think we are going to do a question that will illustrate that after we are done with this topic for equity method. Right. You will see that in your question, it will be a combined question for the acquisition method and the equity method. So when you are reading a question, you must be able to understand this is the equity method and this is the acquisition method, so that you treat it appropriately. So let's look at how do you treat the acquisition method. So the first thing that you do is you identify who is the acquirer. A Limited purchased 80% shares in B Limited. So which means A Limited is the acquirer. A Limited purchased 80% shares in B Limited. So A Limited is the acquirer. That's the first thing that you do when you are using the acquisition method. Then you should now determine the acquisition date. Why do we have to determine the acquisition date? So that you have to be able to see the equity at acquisition. What was the equity at acquisition? That's the main reason why you need to determine the acquisition date, so that you determine the equity at acquisition. The reason why you should determine the acquisition date is you will find that in most cases, we don't consolidate on the same day when you acquire a subsidiary. It's not like we are going to consolidate that same day. We acquire a subsidiary today, then we consolidate today. We can acquire a subsidiary today, then we can consolidate, we can do consolidated financial statements after maybe 2 years. So the acquisition date is important mostly in things like the retained earning. You will find that the retained earning at acquisition and the retained earning since acquisition to the date of consolidation will be treated differently. The retained earning at acquisition is going to be part of the equity that was purchased by the acquired. So the retained earning at acquisition is going to be part of the equity that was purchased by the acquirer at acquisition. But the retained earnings since acquisition to the date of consolidation is no more part of the equity. It's now going to be shared between the acquirer and the non-controlling interest. So that's why you should always be able to see the date of acquisition, so that you can determine since acquisition to the date of consolidation, how much profit did the company make, so that that profit can now be shared between the acquirer and the subsidiary. So that's basically why you should be able to determine the acquisition date. Then when you come to step 3, you need now to measure the assets. What is the value of the assets of the subsidiary? The value of the assets that are acquired. That's your step 3. Recognize and measure, which means you look at the assets and you look at the liabilities and you check at any non-controlling interest in the acquirer. You get non-controlling interest here if A Limited acquire 80% shares in B Limited, then it means 20% is going to be non-controlling interest. The acquirer does not control 20% here. So when you do your consolidation, this 20% is not part of the consolidation. It's a non-controlling interest. So that's basically here. Right, then we also have a situation where we need to determine if there is goodwill or a gain on bargain purchase. So goodwill is like the good name of the company. When you buy a company, you will find that here, the value of the assets, these are the tangible assets, you may find that the value is less than the value of the business. So the difference between the value of the business and the value of the assets is the goodwill, which means you are buying the name, like the business is doing well, so they will also charge that when they charge the value of the business. So that is the goodwill. So in that case, you should also be able to determine if there is going to be goodwill. You will have goodwill in your questions. You will see that the value of assets, the value of the assets, let's say the value of the assets is 100,000, and the purchase price, the price that you are going to pay is 120. So the difference here, the 20,000, is going to be the goodwill. So that's how you determine the goodwill. So this is going to be a goodwill. The value of the assets is 100,000, but you are going to be asked a price of 120,000, which means the difference, you purchase the goodwill. Then when it comes to this bargain on purchase is your gain. You are going to buy the business at a less price than its value. That's a bargain on purchase. So which means this will be vice versa. Let's say the value of the assets is 120,000. Then you pay the price of 100,000 here. So you gain a bargain on purchase. It's a gain on bargain purchase that way. So that's the difference between the two. So when you are doing your questions, when you calculate the value of the assets and the price, and you see that the value of the asset is greater, is less than the price, then you have goodwill in that question. But when you see that the value of the asset is greater than the price, then you have a gain. You can even see for yourself, it's going to be, you gain because you purchase at a discount. So that is going to be a gain. Then here you purchase at a premium. Then that premium is going to be goodwill. All right, so that's basically there on goodwill and bargain or gain on bargain purchase. Let's look at what they say here. They say goodwill is a non-current asset which is measured as the difference between the fair value of the consideration transferred and the fair value of the identifiable asset. So which means the fair value of the consideration is the price that you pay, and this is the value of the asset. So the difference between the two is going to give you that goodwill. Right, then a gain on bargain purchase. This one, you take it to other incomes when you do your consolidation. So you will find that here, we're now looking at the fair value of identifiable assets is more than the fair value of the consideration, which means what you pay is less than the value of the assets. So that's when we have this bargain or gain on bargain purchase. Some of the questions we ask you, you may find in your test or whatsoever, they can just ask you to calculate the goodwill. The question will just say calculate the goodwill. I think we will see there's a question that we are going to do the calculation for goodwill, or they can just say calculate gain on bargain purchase. We're going to see it when we do a question, but for now, let's go through the terms. Right. Non-controlling interest, non-controlling interest. Non-controlling interest is what is going to be what is not going to be part of the acquirer's interest. So you only have non-controlling interest if the acquirer did not purchase 100% interest. That's when we have non-controlling interest. But if the acquirer is purchased 100%, there is no non-controlling interest. You can only have a non-controlling interest if the acquirer has 80% interest in the subsidiary. Then it means the difference, which is 20%, is going to be non-controlling interest. But now, one thing at third level, remember what this one with International Financial Reporting Standard 3 and 10, these are the ones that we did at 2602. But you will see that there are certain changes that have been implemented into the third level syllabus. If we look at second year, we were measuring non-controlling interest using only one way, but now we're using two ways, which is at their proportionate share of the subsidiary's identifiable assets and at their acquisition debt fair value. If you look in our previous FAC, we're only using this one. They are measured at their proportionate share of the subsidiary's identifiable assets, which means you are now going to add all the assets for the subsidiary. For an example, if you get all the assets for the subsidiary, they are 100,000, and non-controlling interest is 20%. So this is going to be your NCI measured at the proportionate share of the subsidiary's identifiable asset. So it's going to be 20% of the value of the shares. But when we go to the fair value, it means we are going to determine the fair value of the shares of the subsidiary. The fair value is different from here. Here we are using the net realizable value, but here we are now using the current market value of the shares. That's the fair value. So we can also measure non-controlling interest using the fair value. So the difference is between the two. Let me just go there and look. So in your question, what you should look at here is which method are you using to measure non-controlling interest? It will be shown in your question. The question will say non-controlling interests are measured at their proportionate share of the subsidiary's identifiable assets or they can say they are measured at their acquisition date fair value. So you should always look at the question. But what I want us now to pick is, where is the difference? I think that's the most important thing. Where is the difference? Is it not explained down here? Okay, if they didn't explain, but I think it is explained. But let me just go through the explanation here. The only difference is when you measure non-controlling interests at their proportionate share of the subsidiary's identifiable asset, you only have goodwill for the parent. Then when you are using the fair value, you will have goodwill for the parent and goodwill for the subsidiary. The reason why you are going to have goodwill for the parent and goodwill for the subsidiary is that you are going to have it from the difference between the fair value and the value of identifiable assets. So the value of identifiable assets and the value of fair value, the difference is now going to create goodwill for the subsidiary. If we are using the fair value method. So that's the only difference. So which means here we are going to have goodwill for the parent and goodwill for subsidiary. So that's the difference between the two. So when the question requires you to measure a non-controlling interest at fair value, then you should know you are going to have two goodwills, one for the parent and one for the subsidiary. Then you add them together. Then when you go to do your consolidated statement of financial position, then you take that goodwill to the consolidated statement of financial position. So that's basically the two. But the question will always tell you which method is used. Right. I don't know why I didn't have any. I think we'll meet the explanation down on the notes there. Right. Then consolidation after the acquisition date. When you consolidate after, the only difference between after and at acquisition is, let me just admit someone here. So the only difference between after the acquisition date, remember I say when you consolidate after acquisition date, then it means the business has been trading here. So you should always look at the retained earning. Retained earning. This is the only thing that is going to be retained earning and profit made for the year. So when we consolidate after acquisition date, it means we should look at the retained earnings since acquisition until the beginning of the current year. So if at acquisition the retained earning, let's say, was 50, and then at consolidation the retained earning is now 100. So it means since acquisition to now, the company has made a profit of 50. So that 50 now, when you do your consolidation, that other 50 is not going to be part of the equity at consolidation. It's not going to form part of the equity of the subsidiary. It's going to be now profit that is going to be shared between the subsidiary and the parent. So that's the difference when you are consolidating after, because since acquisition to the consolidation date, the business has been trading, which means it's been making profit. So that profit which was made since acquisition should now be shared between the subsidiary and the parent. So that's the difference. But when we consolidate at acquisition, there is no profit that was made. There is no anything here. It's only equity because the subsidiary is not made any profit. We are making a consolidation at acquisition, which means all the profits which were made by the subsidiary till the date of acquisition are going to form the equity at that date of acquisition. So that's the difference between consolidation at acquisition and consolidation after acquisition. Right, so let's see the procedure. So when we are doing our consolidation, the first thing is to eliminate common items. Right, you will see that when you do consolidation, we are going to eliminate the parent's investment in each subsidiary. We are going to eliminate the parent's portion of equity in each subsidiary. And we are going to calculate goodwill or gain on bargain purchase. Then we can also identify non-controlling interest. You can only see that there is non-controlling interest if the investor did not purchase 100% of the shares in the subsidiary. Then it means the difference is now going to be non-controlling interest. So that's basically when you are consolidating. So the first thing is to eliminate, remember I said the common items. Once you eliminate common items and intra-group transactions, intra-group transactions, you can have intra-group loans, intra-group sales, resulting in a profit or a loss. So here, when you are doing your elimination, if there is a loan that was taken between the subsidiary and the parent, it's an intra-group transaction. So that one you are going to eliminate it before you do your consolidation. For an example, A took a loan of, let's say A is the parent. A give 100,000, 10,000 loan to B limited, right? So if there is a loan that was given to be limited by A limited, when you do your consolidation, you should take out this loan. So which means in your loan, if you had 20,000 balance of the loan between the two companies, then when you do your consolidation, it means you have to minus the 10,000. So which means your consolidation will be on loans will be 10,000 only. So that's how you eliminate this intra-group transaction, which means before you go to consolidate the figures, you must eliminate these common items so that you are left with what is not between the groups. Then when you go to intra-group sales, right? Intra-group sales, we are saying A limited sold, let's say A limited sold inventory to B limited for 25,000 at a profit of, at a markup of 25%. So which means the 25% markup is in here. So what you have to do now, this is an intra-group transaction. Here we say you only consider the profit when B limited it sold these goods to third parties. As long as B limited is still holding this inventory, the profit on this inventory should be eliminated, because we say a group cannot make a profit on itself. So as long as an intra-group transaction of inventory is still within a member of the group, the profit on that inventory is going to be eliminated at consolidation. So which means this one we have to eliminate the 25%. And at third level, remember in our 2602, we're not focusing much on the tax implication. So now we are now focusing on the tax implication. For an example, if you eliminate this intra-group profit of 25%, it will also affect the tax. Remember, you remove the profit, which means the profit goes down. If the profit goes down, then it also means the tax must go down. So you need also to take into account the tax implication. You will see this is very important, especially now at third level, the tax implication. How do you affect the tax implication in your calculation? It's very important, right? I think there's a lot on that in the questions. Right, when you have done your elimination of intra-group loans, intra-common items, intra-group sales, the next thing that you just do is to combine assets. Already here, you have already eliminated the loans. On assets, you have already eliminated any intra-group transaction as an intra-group sale of the assets. So the next thing that you just do is to combine the assets, liability, equity, income, and cash flow of the parent and its subsidiary, which means it's just A plus B. You just come and say asset of A plus asset of B. That's what goes to your consolidation. But the most important thing that we should understand is this consolidation rule, that is to eliminate the common items, eliminate intra-group transaction. Then after we are done, then we can do the consolidation, which means we are now combining the assets and liabilities of the company. We are now combining the income and expenses of the company. So here on income, there's a lot you will see as we go with this on this consolidation, which means here on income, we are now doing the group profit and loss. So in the group profit and loss, you must take note of all these. The profit, which was the intra-group profit, which was eliminated, it must also come and affect your income. Also, all the expenses, if you have eliminated the intra-group profit, it also means the tax must go down. So you must also come here and adjust your income tax expenses as well. So that's how you do your consolidation. So which means the most and foremost thing important is for you to understand how to journalize these before you do your consolidation. I think if you understand the journal entries first, then you will see that you are now only going to apply those journals into your consolidation. Because in your consolidation, journal entries are part of calculation. So if you know you are that person who can only understand the consolidation through the journal entries, you can do your calculations through those journals. Then you effect it to the group profit and loss account, those journals. You'll see when we do the journals, how we do the journal, right? Then there's also this theory. This is one of the questions that you can come across through your theory question. How do you treat a bank overdraft and guarantee between banks of the subsidiary and the parent? Right. If this one normally comes as a theory question, I see it sometimes in some of the theory questions. So here we're now saying a bank overdraft of one entity in a group can only be set off against the favorable balance of the entity in the group. So which means if A has got a bank overdraft, we can only be able to set off that bank overdraft with the balance of A, with the balance of B, if the two entities' bank accounts are at the same bank. That's when you can now be able to set off the bank overdraft of another company in the group. That is, if the two entities' bank accounts are at the same bank, and also the entity with the favorable bank balance is guarantees the bank of overdraft. And this will agree together, even if they have the same bank account, but if there is no guarantee uh, uh, to do that bank overdraft, then it means there is no, the bank cannot do it on its own. So the bank can only do it if there is agreement between the two entities and the bank. So that every time when A has an overdraft and B is having a surplus, then the overdraft of A will have to be covered by the surplus that B has. That is if they are a parent and its subsidiary. So this one is one of the theory questions on groups that you can come across about guarantees on bank overdraft. Right? Intra-group transactions not subject to tax. Remember, we say intra-group transaction like the sale of inventory, the sale of assets, they are all subject to tax, which means if there is an intra-group transaction on inventory, and when you do your consolidation and you are going to eliminate that intra-group profit, then it means you also have to take into account the tax implication in that intra-group profit. I think you are going to see when we do some of the questions. So these are transactions that are not subject to tax. We have, if there is no unrealized profit, as long as there is no profit, remember we eliminate unrealized profit. So if unrealized profit is eliminated, then it will have to have a tax implication. If we just eliminate a common item like a loan, it cannot affect the tax because it does not have any unrealized profit element. We can only have a situation where we have tax because there is unrealized profit that has been eliminated. So once you eliminate unrealized profit, then it means it must also affect your tax. For an example here, you eliminate a profit of 10,000, an intra-group profit of 10,000. So it means on the group that has made that profit, it must also reduce their tax. 28% of 10,000 must be a tax reduction there. You will see when we do the journal entries on these intra-group transactions and unrealized profit. Right. Let's look now at yes.
Hi, Love. Before you proceed,
Yes.
am I audible?
Yeah, we can hear you.
Okay. Before you proceed, I want to understand the loan part. Now, if the acquire loans the acquiree maybe
Sorry?
10,000, if the buying company loans the selling company 10,000 and that transaction exists amongst both of them as a loan, would this still be the case that we must deduct the tax?
If they lose, if the acquirer lose is a loss of 10,000,
Yes.
it's an intra-group transaction and there is
We
a loss
eliminate.
between the two of 10,000.
Okay. Okay.
No, I mean, I'm still asking, are you saying it's an intra-group transaction of 10,000? There is unrealized loss of 10,000. Then you are asking about the tax implication for that.
Yes.
what happens, I've never come across that, but let me just put it in my own understanding. If there is a loss, what loss in profit instead of a profit, we call it a tax benefit. But in this level, I don't think it's going to apply. We call it a tax benefit. It's going to be a tax benefit instead of a tax expense. It's going to be a tax benefit because of that loss. It means it's going to be, but I don't think at this point you can apply that. Because in most of our questions, you will find that we only eliminate this unrealized profit element, which means there is a profit element that was not realized. So in that case, those are the most things that we come across in most of our question. Right? You can even see here, they say the following intragroup are not subject to tax. If an intragroup transaction does not have an unrealized profit element or unrealized loss element. So which means if there is an unrealized loss element, we're not going to focus on that, especially at this level. Remember, these things you'll see when you go to the next level, then that's where you'll focus on things like tax benefit. But for now, if there is unrealized loss element, then it's not going to be subjected to tax. Right, then I want us to look at the allocation of income tax and the elimination of unrealized profit. I think this is the most important part that you guys need to understand. The allocation of income tax and the elimination of unrealized profit. So what we are doing according to the acquisition method, you will see that all the unrealized profit are going to be eliminated in full. We eliminate them in full. So when we eliminate them in full, then we should also take into account the tax implication. What I want you guys to understand when you do your elimination, let me just try to put it this way. Okay, let's just see what they say here. I'll explain what they say here. Here you can see here they say, if unrealized profit generated between two companies in a group is eliminated at consolidation, but no corresponding tax adjustment is made, the consolidated tax expense will be high in relation to the consolidated pre-tax net profit in the group. I don't know if there's anyone who can interpret this statement. I think if you guys understand this one, then it means the tax implication, you understand it. If there is an unrealized profit between two companies, we eliminate this at consolidation, but there is no corresponding tax adjustment, then it means the tax will be high, tax expense will be high in relation to the pre-tax net profit in the group. Is there anyone who can interpret, who understand what is happening on this statement? What exactly is happening on this statement as far as the tax implication is concerned? Right, what happens here is you eliminate a profit here. You come and eliminate the intra-group profit. So if you eliminate the intra-group profit here, let's say you eliminate intra-group profit of 40,000. At first, before the elimination of the group profit of 40,000, this was considered as profit. And since it was considered as profit, it means the profit, the higher the profit, the higher the tax expense. So the time you go now and do your intra-group elimination and eliminate 40,000, it also means that you should also eliminate the tax, which is like now, that much 27% times 40,000. This tax must also be eliminated, which means you must remove this tax, because if you don't remove it, it will be still high because you took out this profit and the company is already paid this 40,000 tax on this 40,000. So if you now go and eliminate this 40,000 and you don't eliminate the tax, it means the tax will be too high here. That's what it means here. So that's basically how you do. So every time when you are doing your elimination, the moment you eliminate a profit, you should also eliminate the tax implication in that profit, which means when you eliminate the tax implication, you are going to have a deferred tax. Remember, I always say deferred tax, you cannot run away from it. It's everywhere. So which means here you are going to have deferred tax asset. We are going to reduce the tax, then it's going to be a deferred tax asset. When you reduce the deferred tax asset, then you are now going to reduce your income tax expenses. This is how your journal will be like. So which means you are going to debit your deferred tax asset and credit income tax expense. So every time when you eliminate a profit, you must also eliminate the tax. So this is the journal for tax elimination. Right, I think that's there on the tax implication. I think this is what has changed from what we were doing in 2602. We were not taking into account tax when we were doing our 2602. So now we are now taking that tax into consideration. But I think that's what happened here. They even now show this is how you do your journal: debt, deferred tax, and credit income tax expense. So you debit your deferred tax and credit income tax expense. Then let's look at unrealized profit in closing inventory. In closing inventory, right? When you have your closing inventory, it arises as a situation where inventory is sold between two companies in the group and not yet sold to third parties. The cost of this inventory will be too high because it includes profit that has not been realized. So the cost of sale increase, resulting in decrease in net profit. So what we do is you will also see that we are also going to make the entity pay less tax. What happens here when you eliminate unrealized profit in closing inventory? It means you are going to increase the cost of sale. When you increase the cost of sale, it means you are going to decrease profit. So which means your journal to eliminate the unrealized profit is going to be you debit cost of sale and you credit to inventory. So what it means here, when you debit cost of sale because of the unrealized profit in closing inventory, then you are now reducing the profit. You eliminate the profit by debiting cost of sale. Then you credit inventory. Then it means you are now reducing the value of the inventory by the unrealized profit. So what it means here is when you debit your cost of sale, you debit it in the profit and loss, then this one in the statement of financial position. So if you are going to consolidate now, the reason why I was saying your journal entries are very important. If you have a journal like this, if the question says do the consolidated statement of profit and loss and statement of financial position. So this journal, it means you are going to affect the cost of sale. You are going to increase the cost of sale here by this unrealized profit. Then you are going to, when you go to the statement of financial position, you are going to minus the inventory by the unrealized profit. That's basically what happens here. Then if it now comes here and say deferred tax and income tax expense. So these are the journals that we normally have when we eliminate unrealized profit in closing inventory. So which means the first journal is going to be to eliminate the unrealized profit. You debt the cost of sale. When you debt the cost of sale, it means you increase the cost of sale. Then increasing the cost of sale will reduce the profit. Then you have eliminated that unrealized profit in closing inventory. Then when you go to the statement of financial position, you are now going to take out, which means you are going to subtract that unrealized profit in the inventory figures. That's how you adjust when you do your consolidation. Then when you go again to your profit and loss, here it will be a statement of financial position. Then this one is going to be the statement of profit and loss. Right. So when you go to your statement of financial position here, it means you have a deferred tax asset as an asset here in the statement of financial position. Then when you go to the statement of profit and loss, it means you are going to minus the income tax expense. If you have an unrealized profit of, let's say, 15,000 here, it means this 15,000 is going to reduce your income tax expense here when you do your consolidated statement of profit and loss. So that's basically what these journals mean. That's why I was saying someone who is still learning how to do consolidation must start to understand the journal's entry first, so that once you do this journal, you can tell what this journal means. If you are doing a consolidated statement of profit and loss, this journal tells you that when you do your sales less cost of sale, it means this intra-group profit that is in the closing inventory is going to increase your cost of sale here, which means you are going to add it to the cost of sale so that you can eliminate the what? The intra-group profit there. Then when you go to consolidate your statement of financial position, you should know the intra-group profit in the closing inventory is going to reduce the inventory and also going to reduce the income tax expense when you do your consolidated profit and loss. So that's basically how these journals work. I think you can see here, the journal entries under the closing inventory will be you debt, cost of sale, and credit inventory. You debt deferred tax asset and credit income tax expense. Income tax expense. You credit income tax expense. Okay, it's here. Right, then there is also one more here. Here we're dealing with unrealized profit in closing inventory. Let's look at unrealized profit in opening inventory. Unrealized profit in opening inventory. So the unrealized profit in opening inventory is not going to affect the cost of sale. It's going to affect, remember, this unrealized profit in opening inventory is now in the retained earning. At the beginning of the year, this unrealized profit will be in the retained earning. So which means the unrealized profit in opening inventory is going to affect our retained earning. You can see here, the retained earning must be reduced the amount of the unrealized profit. The cost of sale will decrease and profit increase. the tax expense will increase. So what happens here, let me just go to the journal. There's something that I want us to. So what happens here when you have unrealized profit in closing inventory, right? There's a difference that you guys need to take note here. Unrealized profit in closing inventory. You are going to reduce your retained earning and you are going to reduce your cost of sale. Why do we reduce the cost of sale? It's because we want to increase at the end of the year. Remember, when we have opening inventory at the end of the year, obvious that opening inventory will be realized, which means it will be sold to third parties. That one is common. There is no way you can start with opening inventory at the beginning of the year and still have that opening inventory at the end of the year. So which means by the end of the year, we assume that the unrealized in opening inventory is now realized. So that's why we credit cost of sale here, because we assume that that unrealized profit in opening inventory has been realized. So in that case, we are now going to credit cost of sale. When you credit cost of sale, what does it mean? It means you reduce the cost of sale. When you reduce the cost of sale, it means you are going to increase the profit now. When you when you increase the profit, then it means you are also now going to increase the tax. So which means you are now going to credit deferred tax liability here, because there's been an increase in the profit here. So that's basically what happens when you have a closing inventory. You can see there's a difference between the unrealized profit in opening inventory and the unrealized profit in closing inventory. Right? I don't know if you guys have a question, especially on unrealized profit in closing inventory and unrealized profit in opening inventory. Because these are the two that you will be working much with. It's either opening inventory or closing inventory. So you must know how do you treat it. Any question before we look? I think we are now on a question and activity one. Unless you guys don't have a question, then we can do activity one together. Then you can see what is happening there. Any question before we do activity one? Right, if there is no question, let's look at this activity. They say B Limited is a subsidiary of A Limited. Every time when you are doing your consolidation, you must quickly be able to see who is the subsidiary. So here, B Limited is a subsidiary of A Limited. During 2015 and 2016, A Limited sold inventory to B Limited at a profit of 25% on the cost of the inventory. You see? Then on 31 December 2015, B Limited had inventory on hand. So B Limited is still holding inventory of 300,000. So the profit in this inventory is the unrealized profit, because it's still in the hands of B Limited. So the profit, we call it unrealized profit. Then they say on 31 December 2016, B Limited had inventory on hand of 200, which had been bought from A Limited. Assume a tax rate of 28%. Prepare the consolidation pro forma journal entries for the year ended 31 December 2015 and 31 December 2016. Right. we want to do the journal entries for this. So which means on 31 December 2016 and 31 December 2015, these are the inventory values that were available, these two. So we need to do the journal entries. These pro forma journal entries are the elimination journals. So which means we want to do the elimination of the unrealized profit in this closing inventory. That's what we want to do on this journal. We want to eliminate the unrealized profit in the closing inventory. So how are we going to do it? Let's just come here into our journal. So the pro forma journal entries is the elimination journals that we are going to have. So we want to eliminate the unrealized profit. Right, so the first journal is on 31 December 2015. What are we going to have? What we want to do here on this is, remember we say our consolidation rule says we eliminate unrealized profit. Unrealized profit is arise from the inventory that is still within the group. So you can see here, B Limited is still holding inventory of 300,000. So which means there is an unrealized element here. There's an unrealized profit element in this 300,000. So we should take it out when we do our consolidation. So this is the journal that we want to do, to take out that unrealized profit on consolidation. So which means we're going to have what? When we eliminate unrealized profit in closing inventory, we debit cost of sale. Then we credit what? Inventory. This is the elimination journal. We are going to eliminate the profit because once you increase the cost of sale, it means you have eliminated that profit. Right. Another thing, when you are doing journal entries for eliminating, you must also take note of whose cost of sale are you going to debt, who is having a cost of sale here. So it's going A Limited sold inventory to B Limited. So which means you are going to debt cost of sale of A Limited, and who is holding the inventory? Obvious is B Limited. So here you should also indicate, you lose marks if you don't indicate that. So which means the cost of sale that we are going to debt is for A Limited, and the inventory, who is holding the inventory, is B Limited. So you are going to reduce the inventory of B Limited. By how much? They say 25% markup. There is also something that there's a difference between 25% on the cost of the inventory. So which means if it is 25% on the cost of the inventory, we are going to use we are going to use 300,000 times 25 over what? Over 125. So this is going to be the intra-group profit that has to be eliminated. How much are we going to eliminate there? Are you guys there? How much is going to be eliminated there?
60,000.
So we're going to eliminate 60,000. So this is the intra-group profit that we are going to eliminate. When you eliminate this 60,000, you also need to eliminate the tax. So when we eliminate 60,000, what is going to happen to tax? Is it going to increase or decrease? This is how you determine which tax journals. Is this the elimination of this 60,000 going to lead to a decrease in profit or an increase in profit? It means it's going to lead to a decrease in profit. So if there is a decrease in profit, then it also is going to decrease our tax. So which means here we are going to have a deferred tax asset here in the statement of financial position. Then we're also going to reduce our income tax expense. We're going to reduce our income tax expense in the profit and loss. Let's just use the percentage that is given. So which means it's going to be now, the tax is now going to come from 60,000. It's going to be 60,000 times 28%. So that's the tax that is going to be reduced. So even now, when you go to do your consolidation, your income tax, it means you are going to reduce it by this deferred tax. How much is going to be our income tax? 1, 2, 3.
16,800.
16,800.
16,000.
Yes, 16,800. So this is going to be our income tax. So what you do here is, if you are now consolidating, why I say you should understand the journal. If you are now going to do your consolidated statement of profit and loss, it means this 60,000, you are going to add it to your cost of sale so that you can eliminate the profit. And then when you go to your statement of consolidated statement of financial position, you now go and take this as a deferred tax asset. You take it to the consolidated statement of financial position. When you go again to your consolidated statement of profit and loss, you now go and reduce your income tax by this figure, income tax expense by this figure. So which means in your consolidation, these are the additions and subtraction that you will be doing when you are doing your consolidation. You go to your income tax expense and reduce by 16,800. You go to your statement of financial position and increase your deferred tax asset by this amount. Then you go to your statement of financial position and reduce the inventory value by 60,000. You go to your consolidated statement of profit and loss and increase your cost of sale by 60,000. That is now when you are doing your consolidation. Right? Unless if there is anyone with a question, I think that's how you do the journal. Any question? I think we can do that one. I think our time, we want to finish there. The same way we did this one is the same way we do the one at 31 December. They are the same. Unless if there's anyone who needs more clarification on this journal. Any clarification on that journal? Right. If there is no clarification needed, let's look at unrealized profit included in property, plant, and equipment. So here, what they mean here is, intra-group sale of property, plant, and equipment, there is going to be a profit there. But as long as that property, plant, and equipment is still with any of the member within the group, then it means we should eliminate the unrealized profit when we do our consolidation. We should eliminate the unrealized profit. So which means if company A sell a PP asset to company B at a profit of 5,000. So that 5,000, we should eliminate it. And when we eliminate that 5,000, we should also take into account the tax implication there again. So every time when we eliminate profit, then we should also eliminate the tax implication there. So this is the same thing, but the only difference between property, plant, and equipment and inventory. In property, plant, and equipment, if you eliminate a profit of 5,000, right, you eliminated a profit of 5,000. But do you know, during that current year, a depreciation was done, including this 5,000. So you now have eliminated this 5,000. So which means the excess depreciation must be added back. So it means that excess depreciation must now be written back. So what it means here is you sold a PP asset at a profit of 5,000, and that PP asset is now going to be eliminated, this profit. So when you eliminate this profit, there has already been depreciation charged here. So that depreciation that has already been charged, it means it has increased the expense of the company. So now when you eliminate that, the depreciation in this 5,000 must now be reversed. So when you reverse that depreciation, it means you are going to increase the profit by the amount of depreciation. So every time if there is a depreciation, then it means that depreciation is going to cause an increase in the profit as a result of reversing that particular depreciation. So that's the difference between PP asset, depreciable assets, and non-depreciable assets. In depreciable assets, you also have to take note of the depreciation that has already been charged there. So which means you have to reverse it back. Right? I think there's a question here which will illustrate this. Let's check what is the question saying. So this one says A Limited held 100% interest in B Limited since 2014. A Limited controls B Limited. They hold 100%, so there is no non-controlling interest. On 2 January 2015, A Limited sold land for 20,000. The carrying amount of the land for A Limited was 15,000. Both entities' year ends fall on 31 December. Assume a normal tax rate of 28%. Capital gain tax is calculated at 80%. Prepare the pro forma consolidation journal for the year ended 31 December 2015 and 31 December 2016. So which means we need those two journals for 31 December 2015 and 31 December 2016. Okay, so what it means here is there is an intra-group profit here. They sold between the members of the group 20,000. The carrying amount is 15. So there's a profit element of 5,000 here. This is what we want to eliminate, this profit element of 5,000. So which means we're going to eliminate that profit. Let's see how the journal will look like here. So we want to eliminate that unrealized profit. Remember, the reason why we have to eliminate it, we call it unrealized profit. The property is still with a member of the group. So every time when we do our consolidation, we have to eliminate the unrealized profit. Remember, this elimination is only done with consolidation. That's when we do. So which means the consolidated statements will be different from the individual statements. Because when we consolidate, we have to eliminate some of the intra-group transactions. So at the end of the day, consolidated statements and individual statements will be different because of those elimination of the intra-group transaction. Right, so let's look at the journal entry. The journal entry is still straightforward like before. It's only here we don't have cost of sale because we are talking of land. So you can just come here and say you are going to eliminate profit on sale of land. Against property, plant, and equipment. So this PP is going to be statement of financial position. Then this one is going to be profit and loss of who made profit here. So that's another thing. Who made the profit? We're going to eliminate the profit of who. A Limited, they say on 2 January, A Limited sold land to B Limited. So which means here, the profit for A Limited is the one that is going to be reduced. And the PPE for B Limited is the one that is going to be reduced. So you have to indicate here. And by how much? This one is straight. It's going to be 20,000 minus 15,000. Then you are going to have 5,000 here, 5,000 here. You have eliminated your profit. And for third level, every time when you eliminate your profit, you must always know that you are going to eliminate the tax. So which means we are going to affect the tax. It's going to be deferred tax in the statement of financial position here, and income tax expense in the statement of profit and loss. Right. So now this is different. If you can still remember when we were doing our, it goes together with AIS, which one? 16, AIS 16. So if you check, when we're doing AIS 16 and AIS 40, if you guys can still remember, AIS 40 and AIS 16, when it is land, land can only be realized through sale. Remember, we say there is a difference between an asset which is going to be realized through use and an asset which can be realized through sale. An asset which can be realized through use, there is no guarantee that we are going to have this profit on it. because it can be used until it becomes new. So in that case, we are not going to apply the capital gain tax. I think if you guys can still remember, like if we have a machine, we say the machine can be realized through use. So in that case, we don't take into account the capital gain on it. So this one is land. Land can only be realized through sale. It does not depreciate. It does not come to a point where we say the land is no longer available. So which means the only way we can realize it is through sale. So which means we are guaranteed to apply the capital gain tax. So it's now going to be 5,000 times 28 times 80%. How much are we going to have there? Are you guys there? How much is going to be the tax there? Times 28.
1,000.
1,000 straight. I'm getting 1,000.
Wait.
120.
No, it's 20 or 28%, yeah. So
1,120. So this is how you do it here. 1,120. So it's very important, this asset. If the asset is realized through sale, it means any profit on it, you need to apply the 80% when you are calculating your tax. If it can only be realized through use, then you only apply 28%. You don't apply this 80%. I think we did it when we were doing our AIS 40 and AIS 16. Right, so this is how you apply your journal for here. And this is how you apply your journal for this part. Right, let's look at if there's anything that we can do on the journals here. Let's look if there's anything that needs to be done. They also say 31 December 2016. What is going to happen on 31 December 2016? If we are to do another consolidation on 31 December 2016, what are we going to, which corrections are we going to do? Right, if we do the one for 31 December 2016, it means we now go and say so the one for 31 December 2016 will now be just a correction. So in that case, we need the retained earning. This profit now will be in the retained earning at the beginning of the year. So in the retained earning, this profit is going to be our 5,000 minus the tax, which 1,000. How much are we going to have there? It's 5,000 minus 1,120, 3,880. So which means we're going to reduce our retained earning by 3,880 here. Then what is going to be another balancing figure? It's going to be our deferred tax for the year, which is still this. Then it balances with our PPE. I think that's the journal that we'll want in the following year. So which means it's going to affect our retained earning here, because this profit, when we go to 31 December, it will be in the retained earning. So we're going to eliminate it from the retained earning. So that's basically what it means here in 2016. You are now going to take it out from the retained earning. You are no more taking it from here on the profit and loss. It's no more there. It's now in the retained earning. So you take it out from the retained earning. Right, so that's how you apply your journal in the following year. Right? Unless if there's anyone with a question, I think there's a last part that we have to do. Let me just check. Impairment of goodwill. I think we did this in our AIS 36, impairment of assets. So we in our International Financial Reporting Standard 10, we're not going to do any calculations much on impairment. They will tell us you impair goodwill by so much. So there is no much work that we are going to do, because we'll be told how much impairment should we apply to goodwill. It's not like in year AIS 36 where we have to go through a lot of calculation to do the impairment loss. Right, so impairment loss is recorded in profit and loss as part of other expense. So if in your questions you have an impairment loss, it means you also need to take it to the profit and loss as part of other expenses. And then another key thing here, impairment of goodwill when non-controlling interests are measured at their proportionate share of the acquirer's identifiable assets. Remember what it means there. We are not going to have goodwill for the non-controlling interest here. So which means even when you impair the goodwill, you are only going to impair the goodwill for the parent. Because remember we say when we are measuring our non-controlling interest at their proportionate share of the acquirer's identifiable assets, we only have goodwill for the parent. So which means there is no goodwill for non-controlling interest. But when we are measuring using, this is the journal entry, if there is an impairment, which means you are going to take to the profit and loss as an expense, then you credit goodwill. Crediting goodwill is reducing it. If your goodwill was 20,000 and you have to impair it by 2,000, so it means you have to credit goodwill with that 2,000. Let's look now if impairment of goodwill when the non-controlling interests are measured at fair value at the acquisition date. Remember here, this is where we have goodwill for the parent and goodwill for the subsidiary. If we are measuring non-controlling interest at fair value, we are going to have goodwill for the parent and goodwill for the subsidiary. I think that's what they are saying here. The amount of goodwill disclosed will be the sum of the goodwill attributable to the parent, the goodwill attributable to the non-controlling interest. And when you have impairment now, you are now going to share the impairment in the ratio of the profit sharing ratio. If the parent acquires 80%, then it means it's going to have 80% of impairment, and 20% of impairment will go to the subsidiary. That's basically how you share the impairment loss on their goodwill. They are going to share in the ratio of the profit sharing ratio, which means the acquisition, the number of the equity at acquisition, and the non-controlling interest. That is if there is impairment. I want us to quickly look at I think this one will also elaborate. This is our last activity. Let's quickly go through it together. Right, this one says on 1 January 2015, P Limited acquired 80 ordinary shares in S Limited for 140,000. P Limited has controlled S Limited since 1 January 2015. The owner's equity of S Limited at the acquisition date is as follows. Right. So you can see here, P Limited is the acquirer, which is the parent, and S Limited is the subsidiary. Then what else? They acquired, every time when you are reading your question, if they acquired 80,000 ordinary shares, you quickly go and look for how many shares are held by the subsidiary. So you can see here the subsidiary is 100,000 shares. So if they have 100,000 shares, then what it means is they did not acquire all the shares. So there is going to be a non-controlling interest. This is also what you should use to work the percentage of interest in the subsidiary. If they acquired 80,000 shares out of 100, then it means they acquired what percentage there? So it's going to be 80 over 100,000 times 100. How much have they acquired here? Is it going to be 80%? 80%. So they acquired 80% here. So the first thing when you are doing a consolidation, you should always look at the percentage that was acquired. So when they acquire, the owner's equity at the date of acquisition was ordinary share capital, retained earning. So you can see this is the equity at acquisition. This is what P Limited acquired. They acquired this value of equity at acquisition, 100,000 ordinary shares and retained earning of 50,000. Right, then let's look at what else do we have there. Then they go on and say, on this date, the assets and liabilities were considered to be fairly valued and there were no unaccounted for contingent liabilities. At 1 January 2016, the retained earning of S Limited amounted to 150. Automatically, it tells you that you'll see they acquired this. Remember when we were doing, we say you should look at the date of acquisition and the date of consolidation. So you can see the date of acquisition is 1 January 2015 and the date of consolidation, let's check, 31 December 2016. You can see that the date of acquisition and the date of consolidation are different. So there was trading after acquisition here. So here it tells you that the retained earning at 1 January 2016 amounted to 150. So which means the difference between the retained earning at acquisition and the retained earnings since acquisition to the beginning of the current year. The difference is the profit which was made since acquisition to the beginning of the current year. So this one now does not form part of this equity, but is now going to be shared between the subsidiary and the parent. So these are some of the things that you should look at when you are answering a question. The date of acquisition and the date of consolidation. Was there any profit that was made after consolidation? Then that profit now is going to be shared between the subsidiary and the parent. But then they say on 31 December 2016, the goodwill of S Limited had been impaired to. So which means the goodwill had been impaired to 5,000. The profit for the year of S Limited was 30,000. Right? Then they say the group elected to measure non-controlling interest in an acquiree at their proportionate share of the acquiree's identifiable net assets at acquisition. So this is how we measure non-controlling interest. We are going to measure them at the acquiree's identifiable net assets on acquisition. So what we are required to do is to prepare the pro forma consolidation journal entries. That when you are doing this kind of a question, I would advise you to start with a calculation. It's easier to do your calculation. Your calculation is going to be the analysis of owner's equity of the subsidiary. So which means you are going to have an analysis of owner's equity of the subsidiary, who is S Limited. Right, so this is how you do your analysis. We have our total here. Then we are going to have at acquisition. Then we are going to have since acquisition. Then we are going to have our NCI. Right, in our case, we have said P Limited hold 80%. Then, which means the NCI is going to be 20%. So you come and do your at acquisition. So at acquisition, what do you have? So at acquisition, what you want to do is to check the equity of the subsidiary at acquisition here. What was the equity of the subsidiary? We have the share capital and the retained earning. So these are the equity of the subsidiary. Which is how much here? The equity of the subsidiary at acquisition is 100 share capital and 50 retained earning. That's the equity at acquisition. So this is 100% equity, which is 100,000 here and 50,000 here. So since P Limited purchased 80%, that's the equity that was purchased here. So how much is going to be 80% of 100? So this is going to be 80,000. Obviously, it's 80,000. Then 80% of 40,000. How much are we going to have there? 80% of 50,000. Sorry.
It's 40,000.
Then this one is going to give us 40,000. So this is the equity which was purchased, which means here the balance goes to NCI of 20,000. Here the balance goes to NCI of 10,000. That when you are here now, what you do is, this is the equity that was purchased. So you need now to draw your line, and you are going to have 150,000 here, and you are going to have 120,000 here. Right. If you check at these figures now, you now go and look at how much was paid by P Limited to acquire this equity of 120,000. This is how you determine your goodwill. You should calculate your goodwill. So you look at how much was paid by P Limited to acquire these shares. They paid 140,000. So this is the consideration that was paid. So here, let's say goodwill. Then we say consideration. So the consideration is 140. This is what was paid. So if this is what was paid, then what is going to be the goodwill? Do you see we're going to have a goodwill? The equity is, it's 120,000, and then the consideration is 140,000. So the difference between the two is going to create a goodwill. If this equity was more than the consideration, then it means it was going to create a gain on purchase. So in this case, the equity purchased is less, the equity value is less than the consideration. So the difference is going to be goodwill. I don't know if you guys, if we are together on what I'm trying to say here. I want you guys to be able to calculate your goodwill or your gain on bargain purchase. So which means the equity, the value of equity purchased here is 120, and the money that was paid is 140. So it means we paid more than the value of equity, which means there was a goodwill in this price of 140,000. That's what it means here. And so here we're going to have 30,000, right? Then you look at here. So there was here. So since acquisition to the beginning of the current year, this is the retained earning. So which means we should look at what happened since acquisition. So then you just come here and say since acquisition. So since acquisition, we have retained earning. So this retained earning is going to be the difference. Remember this one now, the since acquisition is not going to form part of the equity. Do you see here? We only include the retained earning at acquisition as part of the equity. So everything that was made since acquisition is no more going to be part of the equity. So it's now going to be shared. So this is the retained earning at 1 January 2016. This was the retained earning. So the increase in the retained earning is what they are going to share here. So we just come here and say 150,000 minus 50,000. So this is going to be how much? It's going to be 100,000. So in this, is it 100? Yes. So in this 100,000, how much is going to be for the group? We multiply by 80% to get the one that is for the group. Then it goes under the since column. Since acquisition, it's no more going to under the at acquisition. I think it's going to be, is it not 80,000 here?
It is.
Then the NCI is going to be 20. Okay, so that's what happened since acquisition. Then you come to current year. Then you look at what happened in the current. So in the current year, you look for the profit for the year. What was the profit for the year? The profit for the year is 30,000. That's the profit for the year. So you just come here and take your profit for the year. So in this profit for the year, what goes to the group is 30,000 times 80%.
24,000.
So this is going to be 24,000. Then the NCI is going to be 6,000. So this is what happens. So in your question now, there's something that I want to show you. When you have this, when you do your journals, this will be your journal 1. This will be your journal 2. Your journal 2 will come from since acquisition. This will be your journal 2. You are going to record the NCI in this retained earning. Then this is going to be your journal 3, the NCI in the profit for the year. If there were dividends, your dividends will be journal 4. So before you even look for any other journals like impairment of goodwill, it means 5, 6 journals, you must get them from here. So your pro forma journal entries, you get them from here. So which means you're going to have the journal 1 there, your journal 2, and your journal 3, that is the profit for the year, and your journal 4, that is going to be the dividends if they are available. Okay, so let's quickly do, I think we have 3 minutes. Let's look at the journal entries. Let's see if we can do the journal entries with our 3 minutes. So I have already indicated where the journal entries are coming from. So we'll start with those ones. So the first journal is to eliminate the share capital of the subsidiary. It's no more there. This share capital of the subsidiary should now be eliminated. Remember, if you are now to do your consolidated statement of financial position, on share capital, if you are doing the retained earning, you are no more going to have the share capital of the subsidiary because it was purchased here. What belongs to the subsidiary here is now under NCI here. Here. Everything that belongs to the subsidiary is now purchased by. So we're going to eliminate this and only be left with what goes to NCI. So that's how you do. So that's your first elimination pro forma journal entry. So which means you are now going to eliminate the share capital. Remember, share capital is a credit balance. So when you eliminate it, it means you are going to have a debt balance. So we're going to have retained earning, and who else? The goodwill. Then we have our NCI. So our share capital is 100,000 here. We eliminate our retained earning is 50,000 here. Our goodwill is 20,000 here. Our NCI is how much here? It's 30,000 here. Our NCI is 30,000. So we credit the NCI, and the investment in S Limited is 140,000. So it must balance if we add this one and this one. So we are only left now with the NCI and the investment in S Limited. So that's the first journal. Then you go to your second journal. Your second journal will come from here. Since acquisition, you need to record the retained earning that is in the controlling interest. You need to record your retained earning, what was taken by non-controlling interest. So which means you are going to have your second journal. So you need to record the retained earning that is in that is in the controlling interest. So which means you are going to have your retained earning here. You take out from retained earning and give it to non-controlling interest. So that is going to be your journal 2. What belongs to NCI is going to be 20,000. It's going to be 20,000. So which means you are going to debt retained earning and give it to non-controlling interest. So that is going to be your second journal. Then we go to the last journal from the analysis. Your last journal from the analysis is going to be your profit and loss. So you want to record what goes to non-controlling interest from profit and loss. So you are going to take out from profit and loss. So which means you are going to have your non-controlling interest, profit and loss, then your non-controlling interest, statement of financial position. So which means here you are taking out from profit and loss what goes from profit and loss to non-controlling interest. So which means we take it from our analysis, which is here, 6,000. So that's what we take to NCI from profit for the year. So that's your other journal from the analysis. So I'm going to take 6,000 here, 6,000 here, right? So that's there. Then you go and look at the last journal. The last journal here is going to be the impairment of goodwill. When we impair goodwill, they say goodwill is been impaired to 5,000. So how much is our goodwill? Our goodwill is 20,000 and it has been impaired to 5,000. So which means we are going to impair goodwill. That is going to be our journal 4, the last journal here. The impairment of goodwill. So we take it to profit and loss under impairment loss. In the profit and loss. Then what we do, we credit goodwill in the statement of financial position. By how much it's going to be, our goodwill is 20,000. It has to be impaired to 5,000. So which the impairment loss is going to be 15,000 here and 15,000 here. Right. So that's how you do your journal. So if you check when you do your journals, most of your journals comes from here, from this analysis. This is where most of your journal comes from this analysis. So which means you have a journal at acquisition. Since acquisition, then the journals on current year. On current year, you may find that sometimes here we might have dividends that were declared. So which means you should also have your journals for non-controlling interest dividends that were taken by non-controlling interest. So every time when you have your journal entries, your journal entries can come from here. But another thing is, let's say the question requires you to do journal entries. If you understand how to build these journal entries without the analysis, you can still do your calculation here. For an example here, the retained earning, you can just come here and say it's 150,000 minus 50,000 times 20%. 20% is the NCI. It must give us this amount if it is correct. The same applies to here. You can do your calculation here as well if you want. It's 30,000. That's the profit. So you can just come here and say 30,000 is the profit for the year times 20%. That's the non-controlling interest. It must give us that 6,000. You can calculate it inside there. Then when you come to here, you must be able to calculate the NCI. Here, I think that's there. And you must be able to calculate the goodwill. When you are calculating your NCI without using the analysis, you just come here and say 100,000 plus 50,000 times 20%. That's the NCI. It must give us that. Then when you calculate your goodwill without the analysis, you can just come here and say 100,000 plus 50,000 times 80%. Times 80% minus the consideration, then it must give us the goodwill. So if you don't want to do the analysis, let's say the question requires you to do the journal entries. You can still calculate your goodwill. You can still calculate your NCI. You can still be able to calculate even here your non-controlling interest that goes to your retained earning that goes to non-controlling interest. Even on the profit for the year, you can still be able to calculate it. So the analysis is just a calculation. So if you have another way of calculating that is reasonable, you can still use it, because this analysis is just a calculation so that you can have accurate figures on it. So if you don't want to do the analysis, because I know it always takes a lot of time. It's accurate once you are done with it, but it takes a lot of time. Then you can come and use this format to calculate your goodwill, your NCI, and your retained earning, and your profit for the year that goes to the NCI. Right, I think we're done for this, but we're still on the way. Groups are still on the way. But for today, I think we're done, which means our next class will be on Saturday. Saturday will be a long class for revision. So yeah, so we'll be doing a long class for revision. I'm still trying to look for what I think can come. So I'll check and send it to you guys. At least tomorrow you must have the questions that we are going to do together on Saturday, so that you can go through them before Saturday. Unless if there's someone with a question, I think this is the end of our today's class, and we'll meet on Saturday.
Thank you.
Thank you.
Okay, Saturday.